High-frequency trading, or HFT, uses powerful computers to execute trades incredibly fast. These systems analyze market data and make decisions in milliseconds, far faster than any human could. HFT firms use complex algorithms to identify and exploit tiny price differences across different exchanges. HFT algorithms are designed to react to market changes instantaneously. They can detect and act on price discrepancies that exist for only fractions of a second. This speed gives HFT firms a significant advantage in the market. HFT has become a major part of modern financial markets. It accounts for a large percentage of the total trading volume in many stock markets around the world. This prevalence has raised both praise and concern. Several factors contributed to the rise of HFT. Advancements in computer technology made faster processing speeds and data analysis possible. Changes in market structure, such as the introduction of electronic trading platforms, also played a role. Exchanges began offering incentives to attract HFT firms. These incentives were intended to increase market liquidity and reduce trading costs. However, they also fueled the rapid growth of HFT. The proliferation of fiber optic cables and the development of co-location facilities where HFT servers are placed close to exchanges further accelerated the speed of HFT. These technological advancements gave HFT firms a significant edge. The increasing availability of market data also contributed to the growth of HFT. HFT firms rely on vast amounts of data to fuel their algorithms and make informed trading decisions. HFT has had a significant impact on market efficiency and liquidity. Proponents argue that HFT helps to narrow bid-ask spreads, making it cheaper for investors to buy and sell securities. This increased efficiency benefits all market participants. HFT also contributes to increased market liquidity. By constantly buying and selling securities, HFT firms provide a readily available pool of buyers and sellers. This makes it easier for investors to execute trades quickly and at favorable prices. However, critics argue that the liquidity provided by HFT can be fleeting and disappear during times of market stress. This can exacerbate market volatility and create instability. Despite its potential benefits, HFT has faced numerous criticisms. Some argue that HFT gives an unfair advantage to large, well-resourced firms. Smaller investors lack the technology and infrastructure to compete with HFT firms. Concerns have also been raised about the potential for HFT to manipulate markets. The speed and complexity of HFT algorithms make it difficult to detect and prevent manipulative practices. The 2010 flash crash, in which the Dow Jones Industrial Average plunged nearly 1,000 points in minutes, highlighted the potential for HFT to contribute to market instability. This event raised serious questions about the risks associated with HFT. Another criticism is that HFT can create a two-tiered market, where HFT firms have access to information and trading opportunities that are not available to ordinary investors. This perceived unfairness has eroded trust in the market. Section 5. Regulatory responses to HFT. Regulators around the world have responded to the challenges posed by high-frequency trading with a variety of measures. Some regulators have implemented circuit breakers, which temporarily halt trading when prices move too rapidly. This is intended to prevent flash crashes and other market disruptions. Other regulations include increased market surveillance and monitoring of HFT activity. Regulators are also exploring ways to improve transparency in HFT practices. Some jurisdictions have introduced taxes or fees on HFT transactions. This is aimed at reducing the profitability of HFT and discouraging excessive trading activity. Section 6. The future of high-frequency trading. The future of HFT is likely to be shaped by ongoing technological advancements and regulatory developments. As artificial intelligence and machine learning become more sophisticated, they may be integrated into HFT algorithms, further increasing their speed and complexity. Regulators will continue to grapple with the challenges of overseeing HFT and ensuring market fairness and stability. New regulations and enforcement mechanisms may be necessary to address evolving risks. The development of new trading technologies, such as blockchain and distributed ledger technology, could also impact the future of HFT. These technologies have the potential to increase transparency and reduce the need for intermediaries. The competitive landscape of HFT may also evolve. Smaller firms may find it increasingly difficult to compete with larger, established players. Consolidation within the industry is a possibility. Section 7. The impact on individual investors. Individual investors are also affected by the rise of HFT. While HFT may contribute to lower trading costs and increased liquidity, it can also create challenges for individual investors. The speed and complexity of HFT can make it difficult for individual investors to compete with professional traders. They may lack the technology and resources to access the same market information and trading opportunities. Individual investors may also be more vulnerable to market manipulation and instability caused by HFT. The rapid price fluctuations and increased volatility can make it difficult for individual investors to manage their portfolios effectively. It's important for individual investors to be aware of the potential impacts of HFT and to take steps to protect themselves. This includes using limit orders, diversifying their portfolios, and staying informed about market developments. Section 8. Conclusion. High-frequency trading has fundamentally transformed the landscape of stock investment. While it has brought some benefits, such as increased liquidity and reduced trading costs, it has also raised concerns about market fairness, stability, and transparency. The future of HFT will depend on the interplay between technological innovation and regulatory oversight. Finding the right balance between fostering innovation and mitigating risks will be crucial for ensuring the long-term health and integrity of financial markets.